Manning or Brady? Jordan or James? Growth or value? These are some of the greatest rivalries of all time. Today, I hope to solve one of the three. Is growth investing or value investing better? And of course, that all depends on how long you have, how much risk you want to take on, and ultimately what you want as an investor. But what you should be asking is,
what is growth and value investing? When should I consider each strategy? Can you use both strategies at the same time?
well, fear not, because I'm here to answer them. But the best type of investing is to invest in yourself by liking and subscribing to this YouTube channel. Now, time is money. I don't plan on wasting yours, so let's get into it. Thomas Rowe Price Jr. is known as the founding father of growth investing. In 1950, Price set up the T. Rowe Price Growth Fund. If you haven't heard of this fund, then don't worry. The important thing is, over its 22-year period, it averaged 15% growth every single year. And today, it's one of the largest financial services firms in the world. On the other side of the fence, Monash Prabhai. He's a very famous value investor. And he's also famous for spending over $650,000 to have lunch with Warren Buffett. I hope there was a lot of value in that. According to Forbes, Prabhai has no interest in companies that are 10% undervalued. He aims to make 5 times his money in a few years. If an opportunity isn't stupidly obvious to go for, he'll pass on it.
But how successful has he been?
Well, if someone invested $100,000 in 1999 with Prabhai, that investment would have grown to $1.8 million in March in 2018. These are two of many giants in this space.
Jordan, where's Warren Buffett in this?
I'll get to that in the end, but first, growth stocks. Growth stocks represent companies better than average in earnings in recent years, and they are expected to continue delivering these high levels of profits and growth, although there are never any guarantees. There are a few key characteristics of growth stocks. 1, they're higher priced than the broader market. With growth stocks, investors are okay with spending a little bit more for companies with a higher PE value ratio, with the expectation they'll be able to sell these companies at an even higher price because they'll keep delivering this growth. 2, a high earnings growth record. This is a bit of a strange one, but basically, when the economy isn't doing that crash hot, these companies are still expected to do just as well, or if not better than they were before. Number 3, they're more volatile than the broader market. The risk when buying growth stocks is because they're priced so high, there's a chance that they could just drop at any time quite significantly, but especially on delivering bad news, and especially if earnings are disappointing. And again, that's because you're buying them based on the fact that their earnings are meant to be continuing to grow at these impressive rates. I consider growth stock picking as kind of being an optimist. Someone who sees the potential of a company when it's already doing really well. The risk is inherent in that it might not do so well in the future. So is a growth stock a really good pick? Well, before we get into that, value stocks. Value fund managers look for stocks that have fallen out of favor with the manic market. But these companies should still have really good fundamentals. The value group of investors might also look for new companies that haven't necessarily been found by the market just yet. The key characteristics of value funds are 1, they're lower priced than the broader market. The idea with value investing is that you're buying really good companies that are just currently or temporarily priced really low. You hope that they'll bounce back when and if the true value of the stock is recognized by the market. Number 2, they're priced below similar companies in the industry. Value investors believe that a majority of value stocks and companies are created because investors and the market are overreacting to insignificant problems, or problems that can be easily fixed. These include things like disappointing earnings, negative publicity or legal problems, or the launch of a bad product. And all of these things can raise doubts about the long-term prospects of a company. I think a really interesting point to make here is the fact that a lot of algorithms are now trading on the stock market, and how these are set up to react to negative news is something I'm considering a lot in my research. Are algorithms overreacting or underreacting? Number 3, they carry somewhat less risk than the broader market. In this way, value investors normally seek a longer time horizon. That's because they may carry a bit more price fluctuations than growth stocks.
Alright Jordan, enough, I get it. I know what they are now. Which one is better?
When answering that kind of question, you need to keep a few things in mind. You have to think, what's your time horizon? How much volatility can you handle? And of course, how much risk can you endure? Value stocks are considered less risky and less volatile, and that's because they're found among larger, more established companies. However, this is not always true, and you have to have a really strong fundamental analysis to understand the good companies from the bad, especially when you're looking at new businesses the market hasn't found yet, or if there's not that much data on them. I've gone through some ways to analyze stocks in a previous video, link up top. Some people say a benefit of value stocks is that because they're priced so low, Even if they don't hit the price mark that you think they're going to make, they might still have some capital growth in between that. And another benefit on top of that is that they might pay dividends. Growth stocks are completely different. They usually don't pay dividends, and they'll normally reinvest that money to grow their business. And that's because they want those healthy growth rates, because that's what investors are there for. Those kind of stocks have potentially a higher probability of loss, especially when companies can't keep up with those growth expectations. For example, a company that releases a new product and hinges their whole business on this new product's success, well, it can go really badly if that product fails. Growth stocks are generally known to have a higher risk but higher reward potential. But is that true? And what does the data say? Research analyst John Dowdy published a report on Seeking Alpha on this exact topic. He broke down stocks into different categories that reflected both the risk and the return of value and growth companies. He looked at the small, mid, and large sectors. The study reveals that from 2000 to 2013, value stocks outperformed growth stocks on a risk-adjusted basis. This was for all three levels of market cap, and this is also despite they were actually more risky than their growth counterparts. But weirdly enough, this wasn't the same for shorter periods of time. From 2007 to 2013, growth stocks actually had higher returns in every single cap class. The author unfortunately concluded that there was no real clear answer, at least on a risk-adjusted basis.
Come on, Jordan, is that the only answer you have for us?
Well, a different study suggested otherwise. Craig Israelson published a study in Financial Planning magazine in 2015. Again, that study looked at all three cap sizes for growth and value companies, this time in a 25-year period, from 1990 to 2014. It showed that large cap value stocks actually outperformed large cap growth stocks by about 0.75%. That difference was even larger for mid and small cap stocks. But that study also showed that over every single 5-year period, large cap growth and value stocks were evenly split in terms of which one performed better. Again, over those 5-year periods, small cap value beat its growth counterpart about 3/4 of the time. However, there were some times when growth stocks did beat value stocks, and when they did, it was at a lot bigger gain. Small cap value stocks beat growth stocks 90% of the time over a 10-year period, and mid cap also beat its growth counterpart.
So Jordan, what's the bottom line? And how does Warren Buffett come into this?
The decision to invest in growth or value stocks is really up to an individual investor's preference, which includes your risk tolerance, investment goals, and time horizon. Over shorter periods, it looks like the data is suggesting growth stocks will be better. But the performance of either a growth or value stock will really just depend on the point in which we're up to in a market cycle. For example, value stocks tend to do well in bear markets and in recessions, while growth stocks tend to do well in bull markets or economic expansions. This factor needs to be taken in for those who are trying to time the market and do shorter term trades.
Jordan, what do you do?
Look, I personally like to find growth stocks when they represent value. Does that sound crazy or too good to be true? Well, it's not, but it takes a lot of patience. Previously, I invested in a waste recycling company. At the time, the stock was beaten up savagely, and that's because it was going through some legal proceedings. Basically, the government was deciding whether it was going to be anti-competitive or not, because they were looking to buy this really big project that would help their company a lot. But I saw this as a good thing. The company was growing, like it's going to buy this project and become a really strong company. So I saw it as a growth company with value. I bought this stock at a big discount, and then when the stocks found in favor of the company, the stock price soared. Then the company continued to grow as projected. So I got that value play when you're buying at a low depressed value that comes back up to its real value. And then I got a growth play out of it because it continued to grow at those really good levels. Personally, I think this is what Warren Buffett tries to achieve, and it's what he's been doing more recently. He started out as a deep value investor, a Graham fanboy. For example, he never said that he'd invest in Apple, a growth stock. But now it's one of Berkshire Hathaway's major holdings. Go figure. The stock market is changing rapidly, and the stocks available in it are numerous and varied. Being a strict growth investor or value investor might really limit you in terms of what companies or stocks you're looking at playing in. So think about that next time you want to label yourself as one or the other. If you want to stay up to date on all the investing decisions and know-how, hit that like and subscribe button. Leave me a comment down below. What do you think is better, growth or value investing? And which do you use? Next step, think about what style you prefer. For me, I'm going to continue looking for those rare growth but value type investment opportunities. Oh, and of course, check out another video, here, or here, and I'll see you again soon.